Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Oana.
Okay, we're going to go over this article to rent versus buy one. But what's cool about it is there's actual information here that will probably surprise you because when you do these rent versus buy things, there's something extremely misleading about them that they never tell you. And by having this information, you will be like at a cocktail party and people will be talking about this thing. You'll be able to say, oh, but there's this thing I know. And then you'll explain it to them and like, oh my gosh, you're super smart. Because you're super smart about real estate because you watch this show. We are one of the top shows on YouTube for real estate.
There you go.
I don't know what the number is. It could be 10, it could be 1,000, but we're up there. We're definitely closer to the top, I think. I don't know. I haven't checked. I just know that we're not the Crash Bros.
Okay.
Okay, so this is what we're going to do. We're going to hit the headline, and then we're going to go talk about the data in the article, and then we're going to give you real world examples, and then we're going to come back to the headline because there's something funny in there.
Okay.
Okay, all right. Anything you want to say before we get started?
If you want to buy or sell a house in Vegas, please reach out to us. We are not just talking heads on YouTube. We are practitioners, and we'd love to do business with you.
Yep, we're actually going to meet somebody today about selling their house.
There you go.
Okay, here's the headline. Renting will be cheaper than buying for years, especially as home prices keep setting new all-time highs. We'll get back to that. Okay, but this is the thing. Okay, so what they've done is they went to the top 50 metros and they looked at the rent versus buy and they came up with all the numbers, okay? Now, here is the quote from the article. We're going to spend a lot of time on this. Okay, it's cheaper to rent than to buy in all of the top 50 metros, the biggest 50 markets in the U.S. The typical monthly mortgage payment of a median-priced home, this is per Redfin, median-priced home in that market, $412,000 in the U.S. is $2,703. Well, the national typical monthly rent is $1,979 as of February, a 36.6% difference. Okay, Oana, let's first start about. We're not disputing the numbers, but we're going to explain what they actually are. Okay, how do you think they got this 2703 for this 412? Like they just, because everybody who buys a $412,000 house doesn't have a $2,700 mortgage payment, right?
That is correct.
Some people have no mortgage payment.
That is correct.
Okay, how do you think they came about this number?
That's a great question. So, did they just say, hey, let's just pick the FHA mortgage rate, so 3% down, and that's how you end up with $2,700?
And like the prevailing rate of 7.5%.
Right. Did they pick a VA loan with 0 down? Did they pick a conventional loan with 10% down, 15% down, 20% down? Did they pick the people who buy cash and don't have a mortgage payment? That's really a good question. How did they pick that number?
That's the first thing you have to figure out when you're doing these analyses is how much is your payment going to actually be and what are you getting for that?
Right.
Okay. Now, here's the other thing that's not taken into account in this. Yes, it will be 2703 for whatever scenario they have on day one. And let's say that was at a 7.5% interest rate.
Well, just one more little caveat, just a little one. What if your home is in Texas versus in Nevada? What do your property taxes look like? Because I'm willing to bet the Nevada property taxes are substantially lower, and that would factor into that as well.
Okay. So let's say that it's a 7.5% rate. And let's say in 2 years, rates are below 5, right? It's possible because 2 years ago they were below 5. So 2 years from now, they could be below 5. And, we get a little recession. Best thing for possible for housing would be
a recession.
Nice recession, interest rates would tank. And they refi. And guess what? They refi and they're below rents, meaning all of a sudden you buy this house and let's say you refied it, your payment's $1,800 now. And you're like, hey, my payment's only $1,800. And your next door neighbor's like, I'm paying $2,200 a month now because they've raised my rent every year. And you're only paying how much? And then they say, oh, I couldn't afford to buy because it was too much. But now it's a better deal, right? So remember, this is only on the day you, like every year, the rent only goes up and your mortgage payment never goes up. So that's another thing we want to point out. Now, here's an interesting thing. This is the mind-blowing thing about this analysis. It says the national typical monthly rent is $1,979 as of February, a 36.6% difference. Does that mean if the person that bought that median home $412,000. If they rented it, that they could get that house and it would be $1,979 rent for that house.
No.
Oh, what is that? What does that mean, typical monthly rental?
So they're looking at all kinds of homes, right? So they're looking at, maybe they're looking at apartments, at townhouses, at duplexes, at fourplexes, at single family homes. So they're looking at all kinds of different types of scenarios, and that's how they're coming up with that. Not only that, but even if they're looking at single family homes, which we don't believe that they are, but even if they are looking at single family homes, they're not looking at the same single family home. And what I mean by that is, for example, if you take a neighborhood where, let's say that the homes are between 400 and 450, they're going to have a much lower ratio of rental homes in there than homes that maybe are between 200 and 300,000. So it's a different quality of home. It's a different neighborhood, different amenities. It's a different size home, all kinds of differences. So that $1,900 a month rent, okay, fine, but you're not getting the same type of home. They're not apples to apples, okay? They're just looking at all rents, not rents for those types of homes.
The article admits that they got this number from Zillow, and that I went on Zillow's site, and you can go look this up. They state that they use all available rentals, including apartments. Mm-hmm. So when they say, hey, you could rent for $1,979, why would you pay $2,703? Well, that $1,979 might be an apartment in that market. Mm-hmm. So it's not like if this 412 house is a 4-bedroom on a quarter-acre lot in Tulsa, Oklahoma, and that $1,979 is not that house. It's going to be maybe a 2-bedroom on a that's 1,100 square feet, that's on a smaller lot or something like that. It's not the same house. Here's the reason I know this is wrong, that this data is skewed. Because when I looked at the chart that they gave all the 50 cities. They showed the Vegas median rental is $1,700.
Which it is not. So all of this is really deceptive because we know that Vegas is $2,200.
Yeah. Vegas if you watch our market updates, the median rentals in there, it's between $2,200 and $2,300. It's a median rental. The problem with this analysis is people hear, oh, it's $2,703, but if I rent it's $2,000, people go, I'll just rent, it's cheaper. Okay. But it's not the same house. Mm-hmm. It's a different house. Like the house you're buying is a much better house. I guarantee you, if you are in a market where where your mortgage payment could be $2,700, you could buy a house for this $1,979, but you're not going to buy the median house. It's going to be below me. Think about this. Most rentals, are most rentals in the top half of the market or bottom half of the market?
So most rentals are in the bottom half of the market because remember, these are the starter homes. These are the homes that people have outgrown. These are also the homes that will cash flow for investors. So again, rentals tend to be the bottom part of the market. So in a neighborhood, and I've said this before, in a neighborhood where you're looking at, the bottom part of the market, you're going to have a lot more rentals. As you go up in quartiles, in price points, you're going to have less and less rentals, and that's natural because, of course, the more expensive the home is, the less it will cash flow. Right.
If this is sort of like a magic trick, because what they do is they go, hey, you could rent a house and buy a house. So the house you're going to buy is a $400,000 house. This rental is a $275,000 house. So it's only $1,979. Like, oh, I'll rent that house for $1,979. And then you get to the house and go, hey, wait a minute. This isn't a $400,000 house. You know, it's $275,000, but this is a median rental in this market.
Right.
The median rental is always going to be below the median price home. Mm-hmm. It's like Oana said. I'll give you an example. Our neighborhood, the homes are $600,000 to $1 million. Probably 1 in 10 houses are rentals, if that.
If that, probably less than that.
Okay. We've got a neighborhood where we have a rental. The homes are $300,000 to $400,000. And we know for sure probably 80% of those houses are rentals because we managed like 20 of them for another investor who had rent. They were all rentals. This neighborhood, we're talking about, that's lower end, below 400,000, is predominantly rentals. Mm-hmm. Okay, so when they say typical rent, they don't mean for the same house. They mean for all rentals in that market, including apartments. Mm-hmm. That's the median. So when they're comparing that number, just remember, you're not really saving $700 a month. You're actually just getting a worse product. That's like if I gave you the choice between I'll lease you a car for $500 or a car for $300. You say, I'll take the 300 because that's cheaper. And I go, okay. The $300 car is a 1986 Yugo, and the $500 car is a brand new Tesla Model Y. It's cheaper. Why would you rent the Model Y for $500 with this Yugo for $300? Right? Who doesn't want a Yugo, especially from like 90 or something? The Yugo, great car, right?
Yeah.
Okay. Now here's the amazing thing. Do you have anything? Oh, let's talk about this. We'll give an example. Oana, you just had an investor buy some houses.
Right.
Rental houses.
Right.
What are the price ranges of these rental houses?
So it's really interesting. So the homes were give or take $430. Okay. And the rent is $2,300.
Okay. $430,000 house, right here. Now you're probably going, but Todd, but remember, what's the median price in Vegas? About $580.
Right.
So remember, these rentals are not median homes. They're well below the median homes. An investor wouldn't be buying rental houses for $600,000. That's probably a bad idea.
Right.
But if you did want to rent that median house, it'd be a hell of a lot more than $2,300, right? Because so tell me, why would the house be better? So we're talking about a $430,000 rental versus $580,000 median priced home in Vegas. Why would that other house be $150,000 more expensive?
Well, it's going to probably be in a better neighborhood.
Okay.
It'll probably have more amenities.
Okay.
It will probably maybe have a nicer lot, maybe have a bigger lot, maybe be a bigger house, maybe just be a more quality product.
Okay.
Okay. So all those things go into it. Maybe it's closer to parks. Maybe it's closer to other amenities that people want. All kinds of reasons.
Okay. Just remember this. When you're seeing these rent versus buy numbers where they quote the numbers and they say median price home and typical rent in a market, they're not comparing the same house. They're not saying, hey, this house would be $2,000 a month. Why would I pay $2,700 for it? You wouldn't. You're paying $2,700 for a better house. The other thing they always leave out is the fact that rent is only going to go up. And the mortgage payment will never go up. It'll probably only ever go down. So you stay the same or go down, right?
Right.
Okay, now we're going to jump back to the headline because this I thought was funny. This was in the article. Okay. Renting will be cheaper than buying for years.
Okay. So in all fairness, yes. But again, you're renting a different product than buying. It's kind of like saying that, well, a burger will be cheaper for years than a filet mignon. Well, yeah, it's a different product. I mean, they're both meat. I'll give you that. But that's kind of where the comparisons end, right?
Right. Okay, here's the second part. Especially as home prices keep setting new all-time highs. So, Oana, what does this mean? Keep setting new all-time highs.
So that means that home prices will keep increasing. Now, this is really deceptive because it makes you believe that, okay, rents are here, home prices are here, and home prices will continue to go up, but somehow rents don't keep creeping up with home prices? That doesn't make sense. So, but that's the inference that that rents will stay put and home prices will go up. Now, if you are never intending to be a homeowner, fine, that's all good. But if your intention is to be a homeowner at some point, then this should really scare you because what that says is that home prices will keep going up, which means that gap between where you are and where home prices are will keep growing. Because remember, home prices are growing up at a percentage, and they're growing up at a percentage based on that value versus your income that also goes up as a percentage, but it goes up as a percentage of that particular value. So if you make $100,000 a year and your income goes up 5% a year, great, you're making 105. But if you're against a home that's 500,000 and that goes up 5% a year, you went up 5% and that went up 25. You went up 5,000 and that went up 25,000. So if that happens every year, that home will be farther and farther out of reach every year.
Right. So the idea here is that they keep playing this game with these monthly numbers, but they keep leaving out one important thing. The second you buy a house, your downside risk of prices going up in the future. Your future downside risk is gone because you're a homeowner. You own a home. Now, the other thing that stops is your monthly, even though it's probably more than a typical payment, your rent payment in your area, it stops going up. It can only go down because what you can do is you can refinance it.
Right. I mean, it stops going up as far as,
mortgage payment. We're talking about
mortgage payment.
Does not make it complex.
I mean, so, obviously your taxes and insurance will go up, but those are nominal against that mortgage payment.
Ours has gone up how much in the last decade?
Per
month.
I don't know about per month, but I can tell you per year.
How much in total over 10 years, over a decade?
Over a decade, our property taxes have gone up about $1,000.
Okay, $1,000 a year over a decade.
No. $1,000 over 10 years.
Okay, $1,000 over 10 years.
Not a year.
So it went up $80 a year. It went up $80 a year, right?
Basically, yeah.
Okay, so it went up
about $100 a year.
Okay, $100 a year. Went up $8 a month.
Right.
Yeah.
And our homeowners insurance, that's actually gone up quite a bit. So we started out, it's probably almost doubled from 10 years ago. But again, I mean, okay, yeah, it's doubled, but what does that actually mean? Again, it means like, if 10 years ago the homeowners insurance was, let's say, $1,200, now it's, let's say, $2,400. I mean, it's not substantial.
Rents have gone up more than $100 a month in the last decade. Rents have doubled in the last decade. Mm-hmm. Rents have doubled in the last decade. And people always want to throw in, but repairs and all this other stuff that's just super expensive. Here's the thing.
Okay, so let's talk about repairs for a minute. So repairs can be mitigated, right?
Sure.
It's the same way you have homeowners insurance. So if there's, if there's a fire or, something where you're robbed or whatever, the homeowners insurance pays for that, right? Well, and the same way you can mitigate major repairs. It's called a home warranty, right? Mm-hmm. You can get a home warranty for, somewhere in the neighborhood of about $600 a year. You can pay $600 a year and they will cover things like hot water heaters, air conditioners, heaters, dishwashers, refrigerators, stoves, microwaves. So if that's your concern, you can mitigate that. Most people don't have a home warranty after their first year, so they are self-insured. So if you take that $600 that you would pay the home warranty and you kind of keep that in your rainy day fund every year, then then that'll help with those sorts of things. But overall, all of these costs are really nominal versus the amount of increase that you would have in rent. So, I mean, what did we talk about? We talked about, let's use kind of round numbers. Let's use, $10 a month for taxes, $10 a month for insurance, and let's say $10 a month for let's say it's $100 a month that things have gone up, but that doesn't even.
But that's over 10 years.
But that's over 10 years. And the thing is that, remember, the whole time you're getting tax benefits, you're building equity in your home. So as your home goes up in value, you benefit from that. You benefit from that because now you have wealth, right? I mean, that's what homes are for Americans. They are a wealth building machine.
Let me put this in perspective. All those, if over 10 years, all those things cost you $100 more a month as a homeowner. As a renter, next year your monthly rent payment is going to be $100 more at a 5% rent increase, which is pretty standard. Just like you said, $2,300 a month is what rent is getting on these below median, priced homes.
Right.
Well, next year they're going to be $2,400. They're going to keep going up. We have inflation, and you're going to keep paying more every month for rent. And as a homeowner, you're not. Effectively, you're not. Here's the other thing. In 10 years, the home could double in price. Could be an $800,000 house.
Maybe.
Wow, that's inflationary. Let's say it's not. Let's say it's only went up to $600,000. Well, how much equity do you have in your rental after 10 years? Zero. You're paying $3,000 a month now. But the person who bought the house all of a sudden has a ton of equity that they can either sell and take tax-free, right? Or they can sell it and move it to the next house because they want to buy a different house, and they keep rolling that equity, and they can stay in the housing market. They don't get stuck in this, renting is going to be cheaper. It won't be cheaper because they'll just move all their equity over. This is the thing I hear when people say, I don't see how people can afford to buy in California. Well, they sold their house in Los Angeles and moved to San Diego. And when they sold their house in Los Angeles, they made $800,000 of equity that they pulled out of it. And they went and paid cash, or they put $800,000 down and got a loan for the rest. And they have a mortgage payment, but they're still in the game.
Right. Of course, the other thing that you can do is you can turn your starter home into a rental and go buy something else and start, building your real estate portfolio. So all those things are options.
If renting was such a great deal and economically the best, smartest move because of the monthly payment difference, why aren't renters have a massive net worth from all their gains in the stock market? Like, why are homeowners 40 times the net worth? And I had some Twitter arguments with some Crash Bros over the past week about this, and their answer is always is, oh, well, that's skewed because the homeowners all just have higher incomes. And it's like, no, because we work with people all the time, and we sell their houses and we see how much they make in net proceeds, and most of these people are just normal income people.
Well, and the thing that you and I were discussing is that we've owned multiple homes. And throughout our lives, particularly when we were starting out, it was a stretch for us to buy each home. Yeah. And it was a decision we made. It was a sacrifice we made. And every time we understood that this was delayed gratification, that we were going to invest in this home and by extension, invest in ourselves and in our future and start building our future through home ownership. And I think a lot of people do recognize that. What I want to propose to you is think about the way it used to be not that long ago. Maybe your great-great-grandparents. There was not a whole lot of ownership, right? Because people worked on someone else's land. And so they never had the opportunity to build wealth, and there wasn't any upward mobility. What has given so many people upward mobility is the opportunity to own a home. And I think that is really not kept, really in mind by a lot of people, that the upward mobility that is available for Americans, it is largely due to the possibility of home ownership and home ownership through all the different loan programs that are available out there. Yeah. Because remember, you can put down, if you're a veteran, you can put down $0 down and then purchase a home for, let's say, $500,000. And as that home goes up in value, now you're making, let's say, 5% on $500,000. You're not making 5% on your income. You're making 5% on that appreciation. Now, I understand that mortgage rates are currently higher than 5%, but I'm simply giving this as an example. For the most part, interest rates have been down considerably lower than that for the past, 10 years or more. So, 5% has been something that people have benefited from. I recognize that interest rates right now are 7% or better for some people, depending on credit and all kinds of other things. But remember, most people out there, over 40% own their homes free and clear. And then we have another more than 40% that have interest rates that are well below 4%. And we have probably a significant portion of those that have interest rates maybe even below 3%. So the people that are dealing with these 7% give or take interest rates are a really small portion of the homeowners out there. Yeah. And that's not to discount their predicament, but it's to take a look at the whole market and understand that wealth building is happening for so many people because of the choices that they've made in their lives to be homeowners.
Yep.
So, sorry to be preachy about it. I'm
sorry for the long video.
Yeah. I am a huge fan of home ownership, obviously. I think it is a path to wealth.
90% of all millionaires in the U.S. is because of equity in real estate.
Right. So if you are interested in buying or selling a home, please remember us. Think of us, whether it's here in Vegas or elsewhere. We are happy to help you. Please remember to like the video, subscribe, hit the notification bell, share the video, leave us your real estate related comments. We appreciate them. And we'll see you on the next video. Bye.
Bye.